every Monday now, we break open the exclusive newsletter that goes to subscribers, and we just give a couple of tidbits, things that we think are interesting, a little taste for everybody in the general public. And we got some interesting pieces that I want to talk about here on this Monday afternoon, because we have an FOMC coming up. We're going to talk about yields going into the FOMC and some intriguing commodity spreads. I mean, we're talking about crude oil. We didn't even talk about the fact that gold fell $20 this morning, bounced back, and has been whipping back and forth. So a lot of commodity trading as well. With that being said, you can go check out a free light version of this at subscribers.thesmallexchange.com. You can become a full-fledged subscriber, or you can check out the light version for free, and hopefully you make that conversion to the full-fledged subscription later on. But this week, Pete talked a little bit about whether or not 0% rates are the new normal. And this is a conversation we have, I mean, just every time the Fed brings rates down to 0% and stays there for a little bit. And I brought up that 2-year chart, which I think I have, right here. Looking at the 2-year U.S. Treasury yield for the last 2 decades, I mean, it's hard to say that interest rates this low in the short-term duration products is a new normal, given that we hit a stretch of this from, I mean, call it 2012 until 2015. They didn't lift off of this zero. So the new normal, kind of an overused phrase, and I would almost say that the 2-year at near 0% has become kind of more normal than not in the last decade.
Well, right. And we're at 16 basis points right now. So, it's funny, you go back and look between, the collateral after the housing collapse of this zero rate bond. It doesn't look like that, but all that back and forth. And there were times where you saw a little bit of escape velocity and it come back down. We're closer to between 30 and 35, 40 basis points. So 2.5 times from where we are right now. So while that does look like the same, that's scraping the bottom too. We are truly at a different bottom when we look at an extreme. So it's not deceptive, but it really speaks to, where was a traditional 2-year note, the back and forth of a 2-year note pre housing bubble, and where we've been recently is truly a fascinating part of the curve right now. And, this is something that we like owning over a little bit longer period of time. And my opinion hasn't changed in this at all.
Well, and you bring up an interesting point, which we haven't so to me, when I talk about this becoming a binary trade here in the 2-year, I'm just talking about the fact that in the last, decade and a half, 2 decades, it's been pretty much like, are we at zero or not at zero? And right now we're at zero when it comes to short-term rates. Right. But you bring up a funny thing, which is the last time we were at zero, call it 2009, 2010 until 16, 17, when the Fed started to hike again, that isn't as close to zero in the 2-year rate as we are right now. Like you say, I mean, it's not a huge range, but that's a range of, 0%
percentage basis.
To about close to 1% or 100 basis points. Right now, we are nowhere near 100 basis points. And so that's just a nice little taste of we are at zero like we have been in the past, but this is as close, as low as you can get. And that's why we talk about how this is a really big extreme that could have some upside potential, given the fact that the Fed has never gone negative. Right. And the bet does historically play out in this binary of zero or not zero. It's not, this 3-pronged thing where it's not zero, zero, and negative. And so with that being said, I'd rather be on it's a pain to have to roll and not know if they hike next month or next year. But like you said, this is as close to the bottom of the barrel as they get in terms of these 2-year yields. Even looking at back in 2011, 2012, and 2013, they were bouncing around from 0 to 50 or 100 basis points.
Right. And we'll talk a little bit about this when we start to look at some trades too. But because this is actually a very different looking chart in terms of price action than the 10-year or the 30-year, which is just another treasury security. Just the only difference in it is its duration, the time till maturity. And we're going to talk a little bit about some of the moving pieces of this. And I think it really speaks to why this continues to, while the 10s and 30s have done us well and they're interesting trades, continue to be interesting trades. This one really is something that fits very nicely in that little bit of longer term view.
And also to that point, I bring up this is the daily bell curve of action. And you can see 68% of the time, or one standard deviation right here in this middle ground, the darkest gray area, we're inside of a dime or inside of $10 of daily action here most of the time for S2Y, the 2-year yield futures. And that once again solidifies the fact that this is a longer term binary kind of outcome trade where it's like, if I'm long, I just think the Fed is going to return to normal here. If I'm short, I think we're going negative or through that 0% bound. There's not really much for me. We will scalp anything, but you can't scalp anything inside of $10 worth of action here, Pete. So but that being said, it does create, knowing that I'm only taking, $8 or $10 on an average day in risk or P&L movement, it does it helps the fact that this is a long-term position. You can't really create a long-term position out of like E-mini S&P futures when if you're long on any given day of just, nonsense back and forth, you could be up or down a few $1,000s, knowing that this is only, moving your P&L by about $8 to $10 a day is pretty nice. But let's look at a couple commodity spreads, Pete, as commodities have become pretty in vogue here. I wanted to look at something that you looked at last week, and maybe you can give a little insight as to how you're feeling about it this week, which is crude oil versus its commodity currency in the Canadian dollar. Looking at this in one SMO future against 2 or 3 micro Canadian futures, or the / McDonald's, like we like to say, MCD there. But as we're at extremes here in crude oil for the last several years, Pete, the Canadian dollar is seeing some upside, but not as much as you might think.
No, absolutely. And, this is always, this actually used to be a much more correlated trade. The commodity currency, they call it Canada against crude oil. A lot of the dynamics of oil, where it's pulled from, and the changing mix of the U.S. Sourced oil, U.S. produced oil being such an important component into the price of smalls U.S. oil or any U.S. based oil. The correlation is broken down a little bit, but still an interesting pairs trade, especially when one of them is starting to move to a new range. Now, you look at the Canadian dollars, it's had a great run. I was early to this trade. Frankie actually was, it's still about the same level. Frankie actually liked this trade on Friday of basically selling this Canada extreme and looking to buy some, selling the crude extreme and buying some Canada. So there's a buy play here. Correlation can get a little muddy, which means the pairs trade is muddy when they're both kind of in the middle of the range. We're getting some good movement here. So you're going to see that correlation, interestingly enough, kind of tighten up. And that's where the pairs trade can become really interesting between the two, where you might look at a Canada chart and say, there's no way I'm buying the upper 10% of basically a 1.5-year move from the pandemic lows. When you look at the relationship trade, it's a very different proposition. And you realize how that Canada becomes an interesting component within that pairs trade.
Yeah, absolutely. And that'll be a fun one to continue to looking at the maybe short crude oil at the extreme here, offsetting some of that with the commodity currency that has been historically positively correlated. Again, it may be a long position, 1 or 2 or 3 contracts in that micro Canadian future is a nice pairing there. And I also it's something that you and I have looked at for, it seems like every other week for the last year, Pete, but metals not screaming through the highs, actually a big move lower here today, but kind of saved by the upside in silver, a big bounce back in silver relative to gold this morning. We're not at those upside extremes in precious metals as a whole, but we're pretty close to it. And this has been a pretty good trade, Pete, for the last couple of weeks and last maybe month or two, which is like, you're not going to be able to sell the high in metals, but if they move back towards those highs like they did at the end of last week, I don't mind getting a short spree position on and offsetting it with some theta decay and some premium in the SLV puts. Now, would you prefer to go to so here's the scenarios, like you're short spree, so you're short gold, silver, and some platinum there, and we're looking to get some optionality, some premium to offset some of the risk in there. Do you feel better about doing that in silver with the SLV puts or gold with the GLD put or put spread?
You know what? It's interesting because a lot of times I have a bias as to what which I think will underperform if we're short or overperform if we're long in terms of the hedge. I'm actually turning pretty bearish metals here, and I think they both have some room to go. Now, silver has, for the last 4 days, outperformed by we're out to almost 4.5%. Silver, even though the gold's down, silver is down a little bit. Gold has fallen by more than 4% larger than silver has net fallen. So I'm not playing that silver is going to continue to be the stronger one, but I do like, if I'm going to add something, adding some silver puts here. But I think this is a great place where, that fall in gold and both the fall in silver and a bigger bounce again today. So we saw that bounce in silver. I think these are a little bit being pulled around by that. And maybe I'm wrong, but Bitcoin getting its legs above 40,000 again. But these are weak rallies in gold, relatively weak rallies in silver, because we were at 28.50 in silver. We're barely holding on to $28 right now. So I think these are markets I love because the rallies are weak and maybe getting pulled up by something else. And once the something else either stops rallying or holds in, these markets can give some ground. So again, a great bearish trade that on the theta side, especially with the one tick ETFs, has worked really well for us. I think we continue to go back to that well.
Yeah, absolutely. And then final thing here, with the Wednesday FOMC meeting coming up, I wanted to call to everybody's attention that 10-year, like Pete alluded to earlier, the 2-year is a nice, small, long-term trade that, like I said, reversion to normal or movement back through negative with that S2Y product that just costs you about $60 a trade and only moves about $10 on a daily basis. 10-year, a lot more volatility to it, and something that we'll be looking to, like I said, we won't be doing in the 2-year, we'll absolutely be doing in the 10-year, which is looking to scalp around the FOMC. I mean, this is one that even just here on Monday afternoon, this market actually is already through its projected high for this entire week. And we expect that on FOMC weeks, we almost always expect bigger moves than usual in the 10-year, but rough week last year for rates. Now we're back to about $15 or 1.5% after coughing up, I think, 10 to 20 basis points last week. So just to recap that, a movement of about $16 in S10Y or 1.6%, all the way down to almost $14 or 1.4% today, bouncing back in a big way to $15, again, 1.5%. Where do you see, is this something that you'd look at selling into, given it's a big move, or, we moved lower by so much last week? How are you looking to trade 10-years this week?
For today's move? Yeah, I would definitely look at a short-term scalp here, up 44, 50 ticks. Again, this would be a tight one though. I'm looking for it to kind of fall back into that, 1460, 1470 range, or this is a $30 day and a half scalp here. I think that when you get 5 days of movement like this, it absolutely is. And, a good shout out to you on Friday, where I was I was really reticent to put a whole lot on. Frankie is like, this long 10s, short SM75 is screaming at me, and great pairs trade. Kudos to you, because that paid, we always love to have pairs pay on both sides. That's not the goal of a pairs trade. It's to really slow down the movement and give us a little bit more time to be on the trade. Sure. But here's one where it paid you, 50 ticks on both sides of the trade in a day. So kudos to the guru over there. Well done by you. And shame on me for not actually stepping in a little bit on Friday.
Well, that's where we have to conclude today's segment, because it's not going to get better than that. Thanks so much for that, Pete. Everybody continue to watch yields going into the FOMC and a bunch of commodity stuff to get going. And we will get a bunch of stuff going on the next segment. Splash into Futures is coming up next Monday afternoon. A lot of stuff that's not named stocks moving around. We'll get some trades going here in almost everything. So everybody stay tuned. Thanks.